Your corporate account shows $300,000. Monday morning, you log in, and your stomach drops. $200,000 is gone. Not stolen, not hacked, not a typo. It was legally converted into shares of a bank you never chose. Shares worth pennies. Tell me something. If your money can be transformed without your permission, was it ever truly your money, or just a number you were allowed to look at? Most business owners live inside a comforting myth. The bank is a vault. Steel doors, guarantees, safety. But the modern system treats deposits like fuel, and when the engine starts choking, it burns what's closest. Here's the part nobody says out loud in business school. Above the insured limit, your deposit can be reclassified as emergency capital. The question isn't, can this happen? The question is, which institution gets hit first? Before we go deeper, do a quick mental check. Where does your business keep the can-lose stuff? Contracts, passwords, deeds, backup drives. Your grandfather probably had a fireproof safe for papers he couldn't replace. Treat financial awareness the same way. A small precaution now costs almost nothing. Ignoring it can cost your company its payroll, its suppliers, its momentum. And yes, your jurisdiction matters, so think globally, not locally. Because this story doesn't belong to one country. It belongs to the system. On March 18, 2013, a businessman named Andreas walked to his bank in Cyprus to access funds for his import company. Payroll money, 150,000 euros, earned and deposited legally. But the doors were locked, not for maintenance, not for a holiday, locked by government order. When banks reopened days later, Andreas discovered 70,000 euros had vanished. That's 47.5% of everything above the insured threshold. Gone, converted into bank shares he never agreed to buy. No investment form, no trade, no consent. And what terrified entrepreneurs worldwide wasn't the loss alone. It was the label. This wasn't robbery. It was regulation. It had a name. Bail-in. And versions of it exist across most developed economies. For decades, when big banks failed, governments used taxpayer money to rescue them. Those were bailouts. After the 2008 crisis, public anger exploded. In the United States, bailout-era commitments and rescue measures ran into the hundreds of billions, and politically, it became toxic. Leaders promised, never again. So regulators built a new solution that sounded fair, until you realize who pays. A bail-in flips the script. Instead of the government injecting money, the bank converts its own liabilities into capital to recapitalize itself. In plain language, the bank survives by turning what it owes into ownership. Sounds clean, efficient, responsible. But then you hit the detail that changes everything. A deposit is not legally a box of your cash. It is, in many systems, a loan you made to the bank. That makes you an unsecured creditor, not a protected owner, not a priority. And during a bail-in, unsecured creditors can be forced to absorb losses by being converted into shareholders, whether they want to be or not. Your cash balance can become an equity position overnight. That's why Cyprus wasn't an accident. It was a proof of concept the world quietly normalized. This framework was built deliberately. In 2011, the Financial Stability Board, backed by major central banks and finance ministries, published guidance pushing bail-in resolution tools internationally. Europe moved fast. The European Union passed the Bank Recovery and Resolution Directive in 2014, and Article 44 explicitly allowed the conversion of deposits above 100,000 euros into bank equity under resolution without the depositor's consent. Other jurisdictions followed with their own mechanisms. In the United States, Dodd-Frank's Orderly Liquidation Authority expanded the FDIC's powers for systemically important institutions. Different legal language, same destination, restructure fast, stabilize markets, and assign losses down a hierarchy. First, shareholders get wiped, then bondholders take hits, and then it gets personal. Uninsured depositors, meaning balances above the insured cap. Those caps are not small details. In the United States, the standard insured limit is $250,000 per depositor, per institution, per ownership category. In much of Europe, it's 100,000 euros. In the United Kingdom, it's 85,000 pounds. Everything above those lines can be treated, legally, as part of the bank's emergency loss absorption toolkit. Businesses get exposed hardest because operational cash piles up. Picture a small manufacturer holding $400,000 in one operating account. Payroll for 30 employees, supplier invoices due next week, rent, taxes, materials, real-world obligations that don't care about regulatory frameworks. If only $250,000 is insured, the remaining $150,000 can be considered uninsured exposure. The owner believes it's safe in the bank. The resolution framework can treat it as capital in waiting. And this is not a conspiracy theory. It's published law, public regulation, official policy. It has already been used. In 2017, Banco Popular Español collapsed and was resolved rapidly under European rules. The mechanism worked as designed: fast, surgical, legal. Insured depositors were protected. The structure didn't need to steal. It simply executed what the paperwork already permitted. Now let's talk triggers, because people keep asking, how do I know when my bank is approaching that cliff? Here's the brutal truth. By the time the warning is obvious to the public, it's usually too late. Regulators use a phrase that sounds technical but is often discretionary: the point of non-viability. It can mean failing or likely to fail. That second phrase is everything. It's judgment, not a stopwatch. Yes, there are indicators. Capital ratios like Common Equity Tier 1, minimums like 4.5%, and stress thresholds that raise alarms. But those are backward-looking snapshots. Silicon Valley Bank looked fine on paper until it didn't. On December 31st, 2022, its reported capital ratios appeared strong. Yet within weeks, confidence cracked, liquidity evaporated, and the system moved faster than spreadsheets can warn. On March 8th, 2023, Silicon Valley Bank opened like a normal day. By March 10th, 2023, it was effectively done. In about 48 hours, one of the largest bank failures in U.S. history unfolded, and thousands of companies saw accounts frozen. Payroll systems jammed, vendor payments bounced, operations stalled. The lesson wasn't just banks can fail. The lesson was speed. When liquidity dies, regulation doesn't ask for your comfort. So what does a smart operator do? Someone running a real company, not a hedge fund. You stop treating deposit protection like paranoia and start treating it like treasury management. The first principle is boring but powerful: structural diversification. Don't hold $600,000 in one bank, in one account, above insured limits. Split it across multiple institutions so each balance stays under coverage. Operationally annoying? Yes. Catastrophically safer? Also yes. Then comes the advanced layer: ownership categories and entity structuring. Insurance is often calculated per depositor, per institution, per category. Separate legal entities can sometimes expand insured coverage legitimately. A corporation, a related limited liability company, and certain trust structures may qualify for separate buckets, depending on the jurisdiction. That doesn't replace diversification, but it can reduce concentration risk without adding endless bank relationships. Next is the liquidity ladder. Not every dollar needs same-day access. Keep immediate operating cash in insured transactional accounts for the next 30 days. Push short-term obligations into high-quality government-backed instruments where appropriate, like treasury bills or government-only money market funds, and stagger maturities for predictable needs. The goal is simple: reduce the pile of uninsured deposits that can be reclassified during a resolution weekend. Finally, for larger reserves, consider custody structures that do not mingle client assets with a bank's balance sheet, where legally available. These options trade convenience for segregation. And if your model can support it, reduce deposits further by pairing a smaller cash buffer with committed credit lines for emergency liquidity. You're not betting on collapse. You're buying resilience against a framework that already exists. Here's the bottom line: bail-in authority isn't a rumor. It's operational policy in many places, built after 2008, tested in Cyprus, echoed in later resolutions, and reinforced by how fast modern bank stress can unfold. The only real choice is timing. Restructure while calm, or react when doors are locked. Consider subscribing to stay ahead of the next piece of this puzzle, because the mechanism doesn't need your permission to activate. Let's go deeper into what actually triggers regulatory action, because this is where most business owners misunderstand the risk. Banks do not collapse like a switch flipping off. They decay quietly, then suddenly. Long before headlines appear, regulators and sophisticated institutions are watching a cluster of stress signals that rarely make it into mainstream discussion. None of them alone is decisive. Together, they form the early warning system of modern financial failure. One of the earliest signals is not capital but confidence pricing. Credit default swaps, known as CDS, act like insurance on a bank's debt. When the cost of that insurance rises sharply, the market is screaming that risk is increasing. This happened with Deutsche Bank in 2016, when CDS spreads surged, despite regulators insisting the institution was stable. The same pattern repeated with Credit Suisse throughout 2022 and early 2023. Here's the critical detail. Rising CDS spreads do not automatically trigger intervention. Regulators treat them as opinions, not alarms. That means the smartest money often exits quietly while everyone else is reassured. By the time official action begins, liquidity has already been drained by those who saw the signals early. This is why bail-ins feel sudden to the public but predictable to insiders. Another indicator is emergency liquidity usage. When a bank increasingly relies on central bank facilities or special lending programs, it signals strain beneath the surface. These programs exist to prevent panic, not to advertise weakness. But usage trends are visible to those who know where to look. Rising dependence often precedes deposit restrictions, not recovery. Add management instability, delayed earnings reports, vague language on earnings calls, and sudden changes in risk disclosures. Each seems harmless alone. Together, they form a picture regulators understand very well. And once that picture crosses the internal threshold of likely to fail, the legal machinery activates fast, quietly, and without negotiation. This brings us to the most dangerous misconception, that insurance guarantees access. Deposit insurance protects value, not timing. During a resolution event, accounts can be frozen even if they are insured. Payroll can fail, payments can stall. Businesses don't collapse because money is lost. They collapse because money is unavailable when it's needed. Liquidity interruption is often deadlier than permanent loss. Think back to the companies caught in the Silicon Valley Bank freeze. Many were technically protected, yet they couldn't process payroll, couldn't pay suppliers, couldn't operate. Insurance checks do not move at the speed of commerce. Regulators prioritize system stability, not your payment deadline. Survival requires planning for access, not just recovery. This is why professional treasury management treats deposits as operational tools, not storage. Every dollar has a job and a time horizon. Immediate obligations stay in highly liquid insured structures. Near-term needs move into instruments with defined access windows. Long-term reserves leave the banking balance sheet entirely when possible. It's not about yield, it's about controllability. Notice how this mirrors other areas of business risk. Companies don't rely on one supplier, they don't trust one server, they don't insure only half a warehouse, yet many still trust a single institution with months of operating capital because it has always been fine. And that's not prudence, that's habit. The regulatory framework assumes rational, informed depositors who monitor bank risk and move funds accordingly. In reality, small and mid-sized businesses cannot analyze balance sheets, derivative exposure, or counterparty chains in real time. The system quietly shifted risk downward, then blamed depositors for not managing it. Understanding this isn't pessimism, it's literacy. The rules changed after 2008. The paperwork proves it. Ignoring it doesn't preserve safety. It simply preserves vulnerability. Here's where mindset matters. Protecting capital under modern banking law isn't fear-driven. It's the same logic used in supply chain redundancy, cybersecurity, or disaster recovery. You don't expect catastrophe. You design so catastrophe doesn't end you. Deposit exposure deserves the same discipline. Every major failure follows the same emotional pattern. First disbelief, then confusion, then the realization that the paperwork allowed it all along. The people who survive aren't the smartest analysts. They're the ones who accepted early that convenience is not safety. And this is why the conversation feels uncomfortable. Banks benefit from large, stable deposits. Relationship managers encourage concentration. Higher balances unlock perks, rates, and priority service. None of those perks matter during resolution. In fact, large depositors are precisely the group the framework is built to absorb losses from. If this feels unfair, it's because fairness isn't the objective. Stability is. The system protects itself first. Understanding that doesn't make you cynical, it makes you operationally prepared. So step back and ask a simple question. If your bank froze access this Friday, how many days could your business operate? Not eventually, not after insurance, immediately. That answer tells you everything about your true exposure. The rules are written, the tools are active, the only variable left is preparation. And preparation, unlike recovery, still gives you control.